Insights podcast. My name is Dan Eitel, and I am the founder and lead analyst for Eitel Insights. Today we are going to be going over the Greater Vancouver market, but as you can tell, this is our first video podcast, so hopefully it goes off without too many hitches. And before we do get into the content, of course, we do appreciate all the subscribers from our last podcast when we did ask for hopefully that we could get above 500 over the next few. We're actually near that goal, so hopefully with today's episode that we can surpass 500 subscribers. Again, if you do like the content that we are subscribing, we ask that you give us a thumbs up. It motivates us to continue to create more content for you on a regular basis. And one other thing, we did have a lot of people subscribe to our free newsletter through the website. That's another thing that is available, and it's a nice entryway to become an Eitel Insights client. Without really too much further ado, let's start getting into the charts that we're known for. So the Greater Vancouver condo market actually just hit its it hit another test of this downtrend, right? Basically the second test over the past 6 months. So our average sale price in August was $692,978. Now that is up from where we were roughly a year ago, but it is also much further down than we were at the peak. So during January of 2018, prices were actually right around $750,000, right? So now we're down to $692. We have been as low as $650. So it's up 40 from our near-term bottom, which is what we identify as the middle threshold of this current market cycle, but we are still very much down roughly 60 grand from the peak, leaving us with 8% off of our old peak prices. How have we gotten here, and really where are we going forward? That's of course the question. Some analysts will say, well, we don't know until the data's in. Those are the fundamentalists, and they need that data to show up over the past 3 quarters to tell you what happened. Well, we don't do that. We know what's happened. We're going to start trying to guide you into going forward, especially using these technical indicators. So the last time that this chart or the Greater Vancouver condo market did test this yellow line, which isn't fully established, we'll see if this one does, if this upcoming challenge does hold and sends the market lower, then we'll likely put it into an orange and it'll become more of a strong, solid downtrend. So we'll see. Last time that this did occur in March, the market actually shot lower $38,000 the month after. Of course, that was COVID right in the heart of it and all that. But what we've seen come back and keep this market buoyant, not toppy, but buoyant, is historic government stimulus. I mean, CERB's been giving you free money whether you worked or you didn't. That's a new one for me, but it was a pandemic, so new things happened. Mortgage deferrals were another thing that came about. You didn't have to pay your mortgage, you just tacked it on, added months to the end. Everybody thought it was a great thing and that they were kind of getting away scot-free. No, it's just kicking the can down the road, and now that the can showed up again, it's either going to have to be kicked or you're going to have to pay. And it sounds like you're going to be having to pay your mortgage again, which is sensible and reasonable. Rental evictions are seemingly coming to an end. So if you're not paying your rent, you probably should start, because again, that's really impacted that investor. And once that property is gone, maybe times however many, there will be continued inventory to this market. And that really is the story of today's podcast. As you can tell by the title, inventory is the highest for the condo market in the past 5 years. So we believe that we're going lower with more inventory, less demand. You see a struggle to keep prices at their current levels. They do drop off. With the government stimulus pulling back, rental evictions starting, the mortgage deferrals ending, and CERB at least being limited. If we'll see how all that pans out, but not exactly a buoyant or a fruitful future for this condo market, in our opinion, technically and analytically. And we'll get into the other analytics as we go further here into the inventory and the sales data. One thing that we did notice here recently, and what we've been talking with some of our realtors and some of the other people that we do work with and we consult to, is that there was really that, not a full demand, but definitely an artificial demand because of this potential second wave. So during the first shutdown, obviously it impacted the market, and that did hurt sellers, intermediary, and now we're seeing that inventory rise, which obviously is a negative impact for the sellers. It's a positive impact for the buyers. Buyers have more opportunity, more selection, and time is on your side, especially when you consider all the amount of inventory coming up here into 2021 with all those pre-sales coming to completion. But getting back to why there was this pocket of demand, I mean, with this second wave coming down the pike and with the economic circumstance uncertain, if you were needing to buy sometime in the fourth quarter of this year, first quarter of next year, you probably bought in the summer because you didn't know if you were actually going to be able to go out and buy and do all the auxiliary things that coming or buying a house entails, such as touching it up, going to Bed Bath & Beyond, and who knows what the second shutdown would have brought. So they rushed and did it. Again, that leaves a glut of the demand segment going forward. What's happened has happened. What we're looking at is what's up coming down the pike. So we do believe that inventory will continue to rise out of a need base to sell. Will it continue to trump seasonal averages? Likely not. December is probably not going to see an all-time high in inventory, but leading into next year's spring and summer market, yes, we'll definitely see higher inventory than we see today. Where we see today is actually close to that 2019 that sent that market down the full throttle from 750 right down to 650. Sorry, medium throttle, because we do identify the market bottom to likely be 525,000. Now that won't occur till 2022. What's kind of odd, we've said this for a long time, and people want the time to rapidly increase and go by faster. They say, well, the world's in a pandemic. But it takes time for the rollouts to actually affect. Nobody actually goes broke quick. You actually go broke very slow because you beg, you borrow, and then you go broke unless you start to steal. So, you pay off one credit card with the other credit card. You try to keep the business afloat by starting to maybe rent out your basement suite. Now he's not paying rent. You can't kick him out. Life's really challenging. Sell the secondary property. And that's what's starting to occur. And that's what will continue to occur going over the next couple of years. Not to mention that artificial inventory were from all those pre-sales that did occur and couldn't sell them on an assignment sale. Now they're going to be coming to the market and either looking for renters or looking to sell it, probably both at the same time, in whichever one happens first, they'll take what they can. So again, when you have multiple of those people in that scenario, it's not exactly bullish, let's say, right? And so again, but it does take time. So the bulls are saying, well, why aren't you changing your tune? Well, the market doesn't go straight down. It goes down, up, down, up, down, up. As long as they're lower lows and lower highs, it's still very much in a downtrend. And that's exactly where we are. I mean, we are lower than March. We are lower definitely than the peak. So, and given our forecast, we don't believe that we're going to be going much higher, much longer. We'll actually start to reverse this recent trend of breaking out of that divergent trend and sending the market up to test this newly established staunch downtrend. And again, we are right at that middle threshold. Let's toss the chart up here on the corner here. Again, so you can see we are double testing that downtrend, and we have multiple price examples right in that higher end of that middle threshold between those two yellow lines. Where we identify this market actually going is those bottom two orange lines. And the bottom of that orange line is 525,000. Now, 550 is definitely a possibility. That's a nice round number. But to say that the market might not overshoot down to 525, that's what we believe. It is a 30% correction from top to bottom. So basically another 22% of where we are now. That's why we say, I mean, yeah, there are some markets inside of the 20. Again, 20 markets make up the average sale price of Greater Vancouver, and we deal with the average sale price here publicly. And of course, privately for our clients, we break down all 20 areas. If you just want one, we break that down for you. That's called a single report, and those do help you greatly. We give you actionable intelligence through our analytical interpretation. And clients are continually to grow. So we're happy about that, and we're happy about the knowledge that we can pass on. It is a challenging market. There is, differences of opinions. Just for the stock market, not to digress too much, but there was a poll put out. Is the recession over? It literally was 53 yes, said the market recession was over, and it ended in May. The other 47% said no, and it's not going to end until April of 2020 or 2021. Sorry. So almost split down the middle of the highest minds in the financial industry. So it's fair. You can disagree. We have been right given our past, and we, of course, believe that we're going to be right going forward. The perennial bulls that say buy last week, buy today, buy in 2016, buy in 2017, buy in 2018, you know what they're going to say. They're going to say buy again. So we can't wait to join that crew at an optimal time. When to buy is when you actually see a lot of inventory and prices are in the doldrums. That's when you can take advantage of it. Buying in 2018 and having $60,000 lost of your equity isn't really taking advantage of anything. That's what we did identify. If you're first time for our podcast, we did identify this in 2017, said the detached market had peaked and the condo market would definitely follow. Here we are, right? The market is lower. So going forward, we do believe that we are going lower again. Now, how do we get there? And before we do get onto that, again, just kind of dealing with the over macro look, dealing with the elephant in the room, the United States. One of the things that has been prevalent again from the perennial bulls is there's a fear of missing out, and interest rates might spike, might do this, might do that, inventory, I mean, whatever they could throw, fair enough, right? They should try. The fear of missing out for an interest rate should really be gone. The Federal Reserve just came out the other day for basically a number of times in a row now and said, we're not going to increase interest rates until we see an average above the 2% inflation. Well, we're well below the 2% inflation. And he said that could happen nearer than you think. And then there was a poignant question. He says, well, nearer than you think sounds good. But in your own data, it says that you don't get to 2% inflation until the year 2023. And now you're saying that you want to average above the 2% for a while to mitigate the below 2%. He says, yes, that's true. So is that a near time? 2023? That sounds like interest rates are going to remain low for a long time. So there shouldn't be that fear of missing out for the interest rates, and interest rates stay low plus prices come down. Now you got to win. Now that's when we start to get bullish and we start to take advantage of this opportunity in the market, not where it's currently at. Literally right now, according to our charts, at middle threshold. It's not hot. It's not cold. It's lukewarm. And if you're a lukewarm investor, that's cool. That's the Goldilocks in the porridge. She wants the lukewarm. We want the porridge that was hot, now cold, and we'll reheat it and make the value, basically, to make a poor analogy there. But now we'll deal with the inventory and where it's been and how we see it to continue to go, especially trending forward into the upcoming years. So we'll just toss this up on your screen here now. And what you can see, basically since 2012, there was a downtrend, those two prominent orange lines that sent the market lower. Of course, the market fell right out of bed during that red line from 2015 right up until 2017, 2018. Then it eventually broke that falling knife downtrend, and we saw a snap recovery. What's instigated since then is this black uptrend that has propelled the market higher. Currently where we're at is 6,085 active listings. Now that is higher than the past 5 years of inventory. That's something, right? I mean, it's showing that there's a change in the market. Are they getting optimal prices? No, no longer. We just showed you the price before. It's not peaking. So they're not trying to win the lottery by selling. They're selling out of a need, right? And then you go to the other side, which we'll come up to, is the sales. Is there any need to invest? Is there any prominence to invest? Is there any investment theory out there that says, gosh dang, I can do really well in this current market? I mean, I drove downtown Saturday night, just 9 o'clock, just to see what the activity was. None. None, right? So the downtown draw probably isn't there like it used to be. So you'll see that inventory come up. And again, you do have those pre-sale condos, a lot of them downtown, that are going to be coming up for sale. Investors that bought 5, 6, and everybody complained at the time, said it wasn't fair. Well, again, the prices are going to be lower when they resell them. So are things fair? Not always in a free market. But as long as you buy and sell accordingly, you can take advantage of market cycles, right? So it's not always fair, but opportunities do arise. If you don't take advantage of the opportunity during an opportune time, then there is no opportunity, right? So again, if you bought at the peak just because of everybody else was doing it, you missed the opportunity of buying years before. What we're saying upcoming likely in 2022 on the overall condo market is that will be the opportunity to actually buy, see the prices go back up to the old peak and beyond. No market is a stock inside that it stays inside of a trading range. Once it surpasses a selling range, we go to the next echelon. And that's the nice thing about investing in real estate. Undeniable that you can be a long-term investor. However, when you invest is very important. So location, totally, yeah, sure, that's cool. But timing, that's where we really come in, right? We'll help you time that market so you don't pay peak dollars to see it lose, and then over the next 5 years, you just brought it back to even. No, that's not an investment. Then you have to have a long-term thought process, right? What we do is likely try to get you in that lower third of the market, purchase, and then just see it rise. That's investing. That's literally investing, not just praying to God that over the long term that you'll increase, which it will, but it will also increase that much exponentially more by investing at the proper time, right? So, sorry about that. So again, the inventory is rising above 6,000 for the first time in the past 5 years. And how did we get there? Well, 2 months in a row of over 2,900 brand new active listings, right? So that's a lot of listings. Now, a lot of them are probably expired and had to relist, or they canceled the old listing and relisted at a new price, trying to get some buyers to their property. But again, that need to sell it is there. It's not just toss it on the market. And if If it doesn't sell in 60 days, we'll have a conversation. It's like, well, I need something to happen after 2 weeks. Nothing happened. We got to adjust. That'll continue to go forward. That'll start to change that mindset of the buyer, which is what we've saying would be coming. And I know that we are always ahead of our time, but that's part of the analytics. We're ahead of our time. What it was a frenzied mentality, like just frenzied. Highest offers, highest list price, and multiple offers above that. What we're seeing now is, again, an appropriate priced property will get offers, right? But it's got to be an appropriate price. Is the appropriate price the old high? It's just not. I mean, not in a majority of the markets. You might tell me one market's really hot. Good for you. That's not 20, right? That's not the market. So again, you'll see that ever progress continue, or that trend continue, as that prices have to go lower. That's called chasing the market. That's what we advised our clients to not do, is to sell out early in this market so you didn't have to chase it lower. Looks like we're correct, and we believe that we will continue to be correct. And then, of course, once there is an opportunity to buy, we'll let our clients know, and then, of course, we will educate the public the best that we can as well. That 2,900 brand new active listings is the first time that it happened in over a decade. Can you guess the last time? Of course, it was 2008, 2009, right? So we're seeing similar market events transpire like the last recession. Now, what's different completely about this 08 and 09 recession compared to the 2017 peak in the detached, 2018 peak in the condo market to where we are now? First of all, it's already a longer negative experience of a market progress. So 2008 bottom, basically, I think it was November of 2008. By November or December of the next year, we had already risen back. So the market actually dropped 21% and reclimbed back 19% within 16 months, if I'm not mistaken. I believe it was actually less than that. What we've experienced here is 2007. Well, let's use the condo market because that's our conversation today. So January 2018 was the 750 peak. We're at 692,000 today. So, and again, that's a year and a half already transpired. So this is a longer market cycle than what we've experienced before. One other major difference that nobody wants to talk about, that we're bullish and said buy, and see, we were right last time. Well, okay. The Olympics were coming. You can't stop construction. You can't shut down the economy when you got the Winter Olympics of 2010. We had the Winter Olympics. Everything kept going. So, I mean, that was an external factor that clearly isn't here this time. There was no pandemic. There was no anything else. These charts have indicated that this was an abnormal cycle. Again, in our original article, we did not say this was going to be a usual 3-year market cycle. We did say that this was going to be a prolonged one, mirroring the 90s. And again, so far we're batting 1,000. So now let's get into the sales. One of the interesting things about the sales, just toss this up on your chart here, or on your screen, sorry. August sales were 1,336. Pretty good number. Again, as you can see on the chart, still within our identified range, which is basically just 1,400 sales at the peak and right around 500 sales at the bottom of this range. Again, it did stay within that long-term 4-line downtrend, which is interesting. That line has been there a long time, everybody knows. So again, it was a good month, but nobody wants to remember where we came from. We came from a deplorable month of April. So I'm just going to run down the last 5 months. Now, the last 5 months of sales are usually your seasonal hot market. That's April, May, June, July, and August. That's your hot market. That's when there's a lot of activity, sales, prices, everything's going on during that period of time. Not always necessarily when you get the peak of prices, but when you get a lot of activity, quote unquote, a hot market. So in April, there was only 508 sales. May had 656. June had 1,017. July saw 1,404. And again, August saw 1,336. What's the average of that? The average of that is 984 sales. Okay, that's not good. In all honesty, that's not good. Okay, I'll tell you what a good year was. Average per month was 2016. That was 1,850 average sales per month. We're nowhere near a good market. Is it deplorable? Is it April? No. Once you see an anomaly low for a data point, you are going to see a natural bounce back. That's just a natural factor. But what comes after that natural bounce back? It's probably another low, right? So again, where we go forward, we think that there's going to be less demand. There's going to be more increased supply out of a need to sell and really no need to invest. But there is a need to live somewhere, and there is that demand. And that's what we believe really occurred here over the last 3 months, is that need to live somewhere really extended out because of this potential second wave and potential second shutdown that seems to be in our near future, right? Of course, we hope that it's not a second shutdown, but we'll see what happens. All that being said, what that all leads to is lower prices going forward, more increased competition amongst sellers, and finally the buyers starting to figure out, hey man, we're in charge of this market. I mean, the sellers are literally fighting amongst themselves for my business. You know what? I'm not going to give it to them. I'm not going to give it to them. They really raked me over the coals during 2018, 2016, 2017, 2018. I'm going to enjoy watching them squirm and reel a bit. So, and that's where you get that overshift of mentality, probably likely in the end of 2021, beginning or during 2022, is a fear of overpaying for a depreciating asset. And that's what we're going to steer you away from. We actually are going to become bullish on this market at a certain point in time, just not where it sits right now. Where it sits right now is we're literally in that middle threshold of the current market cycle with an uptrend in inventory, a staunch uptrend, and seemingly a stagnation period of sales. So that's the way Eitel Insights sees the condo market for the month of August. Of course, stay tuned for our September update. And thanks again for checking in. Hopefully that you appreciated the video content that we're starting to provide for you. Again, give us a thumbs up, subscribe to the podcast, and if you feel so inclined, leave us a nice comment. It's always appreciated. Take care, folks.